Hey everyone, in this video we're going to be going through Unit 3, Property. So I mentioned in the previous video that New Zealand doesn't have a capital gains tax regime, which makes it really good to be a New Zealand tax citizen if you have assets, whether that's your house or whether that's stock in the New Zealand Stock Exchange or shares in a business, etc. However, there are certain scenarios where under ITA 2007 that if you do sell land or personal property which are on capital account, you can still be deemed to have income in certain situations. Not your personal home, but in other situations. So let's talk through them. So the first concept we're going to be talking about is disposal of personal property. So per CB3 to CB5, tax will be payable on amounts derived from A, profit-making undertakings or schemes, B, disposal of personal property acquired for the purpose of disposal, and C, disposal of personal property where the person has a business that involves dealing in personal property. So this is kind of going back to that example I've given before where you as an individual can renovate a house or even build a house, sell the house, and it will be on capital account and you might not pay any tax on it, right? Or you could set up a business for the purpose of property development. You might do a couple of them, you might have some scale or signs that you're actually running a business, and you might have more than one transaction, and it might be you quickly turn it around, and in that case you might, in the same scenario with just some slightly different facts associated with it, in that case it might be assessable for tax because then you do have a profit-making undertaking, and your purpose for that is to carry on a business that involves in dealing in personal property. So as you can see, very slight difference, but in one scenario there's tax payable and in another there's no tax payable. And just before we continue, there's an also important note here that per CB4 and 5 it doesn't apply to land, as the definition of property is specifically excludes land. So land doesn't count as personal property. Okay, next point, personal property acquired for the purpose of disposal. So this is linking to this point up here, disposal of personal property acquired for the purpose of disposal. So if that does happen, you do have to pay tax on it. So let's do a deep dive into what that actually means. So under CB4, a person will derive taxable income where they dispose of personal property that they acquired for the purpose of disposal. So again, this is coming back to the previous example, is what's your intention of doing it? Is it to buy a house to live in it, but then your intention changes and then you end up selling it? Your purpose in that scenario would not be to acquire the property for the purpose of disposal. Your purpose would be to live in it, and your scenario has changed. If you're a property developer acquiring land because you want to build apartments on it and then sell the apartments, your primary purpose of that acquisition was to eventually dispose of that property. In that case, you'd be taxed on it. So this will be the case even where a property is a one-off and not connected to a business activity carried on by a person. So I guess it's hard for the tax commissioner to prove this, but if you were to an individual, and even if you're not carrying on a business, it's still relevant if you're buying a land with the purpose of redeveloping and selling it, because then you're not carrying on a business necessarily, but you would fall under this definition up here, which is disposal of personal property for the purpose of disposal, because your purpose, if it can be proved, is to dispose of it. And if we link this back to the previous chapter, the difficulty is if the commissioner has a problem with it and they challenge it, because it will be a civil case, the burden of proof will be the taxpayer. So it's ultimately you to prove that your purpose was not to develop it, whereas the commissioner doesn't have to prove that, right? He just has to have some evidence that he thinks it is, and you have to disprove him. So it's a lot harder from your perspective to prove your purpose. So case law has also established that a person acquiring property might have more than one purpose. For example, you might have the purpose of deriving dividend income plus disposing of the shares later on for profit. So when you acquire property for two different purposes, as is the case above in this example here, per CB4 it needs to be established which of the two is the dominant purpose. So which one was the primary motivator for you to enter into that transaction? Was it to primarily derive dividend income or rental income if it's a property, or is it primarily to dispose of it for profit later on? So per this case law here, CIR versus national distributors, it provides some guidance on how do you determine which one of those is the dominant purpose. So and again, the onus is on the taxpayer, as I mentioned before. So the key facts which allow you to determine which one is your dominant purpose is A, the length of time the relevant property has been held, B, the fact that at the time of acquisition, the person did not expect to hold the property forever and the possibility of sale was contemplated, does not mean that the person had the dominant purpose of resale, and C, a person may have no specific purpose in mind when acquiring the property. So whether a person has the dominant purpose of disposal must be determined at the time the relevant property is acquired. If the taxpayer acquires the property for long-term investment purposes and after its acquisition changes their mind, decides to sell the property is determined to have not been acquired for the purpose of resale. So you need to look at all the facts of your situation to determine which one is the dominant factor. If you're holding it for a long time, you're indicating that maybe you're not trying to dispose of it for a profit, maybe you're trying to hold it for income during that period. But we've also seen from case law that can change over time, and just because you didn't expect to hold it forever doesn't mean that's the dominant purpose is disposal. So a lot of considerations there. What about if you're a dealer in personal property, and that's someone who actually operates a business in dealing with that property? So could be a car seller, could be a apartment reseller or apartment developer even. So this is a person who operates a business in that trade, which if it was in the hands of an individual in a single transaction, might not be assessable. So per Henderson versus CIR, the court approved the following definition of what constitutes a dealer. It's one who is a merchandise trader or one who sells articles in the same condition in which he bought them. So per the original definition up here, if the disposal of personal property where that person has a business involving in the dealing in personal property, that would be assessable income for that person. Okay, so let's talk about deductions if you're disposing of personal property, because we're now having the issue particularly if the income is not assessable, can you actually get the deductions accessible? Because remember in the first chapter we went through and said, well, in order to get a deduction, there must be a nexus to assessable income or carrying a business income. And this has an issue if you're not actually recording the disposal of personal property as assessable income. So the person will be generally entitled to a deduction for the cost of their revenue account property in accordance with SDB 23, and this is designed that the taxpayer only pays tax on the net profit that arises on the disposal of property. So in other words, is if your property disposal is deemed to be on revenue account, i.e. one of these ones up here, in order so that you actually have to pay tax on it, then you get a deduction for it. But you don't get a deduction for it if it's not assessable income. Okay, so let's talk about disposals of land. So under CB6A or CB15B, income tax will be payable by a person if the land was disposed of. Okay, so there's a lot of different situations here. So I'm just going to read through them quickly, but if any of these situations arise, then income tax will be payable. So A, so just keep up because there's quite a few. A, disposed of within 2 years of acquisition and classified as residential land. B, disposed of within 5 years of acquisition and classified as residential. C, acquired for one or more purposes, that includes the purpose of disposing of it. D, acquiring for the purpose of a business, that either land dealing, developing land, erecting buildings. E, used as landfill prior to the disposal of the person. F, not acquired as part of a land dealing business, but the person carries on this type of business at the time of the land's acquisition, and the land is disposed of within 10 years. I forgot what letter I'm up to, so I'm just going to go through them again. Next one is not acquired as part of a land development or land division business, but the person carries on this type of business at the time of the land's acquisition, and the land is disposed of within 10 years of acquisition, i.e. you were a developer at the time, and it wasn't acquired part of that business, but later on the land is disposed of within 10 years. Next is not acquired as part of a business that involves erecting business, but the person carries on this type of business at the time the improvements began, and the land is disposed of within 10 years of the improvement being made to it. Next, part of an undertaking or scheme commenced less than 10 years of the land being acquired and involves development work that is not minor. Next is part of an undertaking or scheme that is not taxable under another provision involving development or division work that involves significant expenditure being incurred on certain types of activities. And finally, not already subject to tax under one of the earlier land tax sections, but disposed of less than 10 years of its acquisition and greater than 20% of the increase in value. So there's quite a number of different situations where land disposed, although ordinarily land is not assessable, if you do dispose of land under these scenarios, you do have to pay tax. So what I would recommend you just doing, reading over these again, just so you kind of understand them, because they're all quite different. They can kind of blend in if you just read through them as one big group. So just read through them a couple of times, or if you get an exam question, you can just refer back to the list and just skim through it and say, do any of these kind of apply to the situation that we're talking about? But that being said, there are certain exclusions that even if one of these situations occurs, the land will not be taxable because of these exclusions. Now, each of these exclusions depend on which of these relevant sections above is occurring. So let's say in the exam, we've got a case study and it's in relation to, this one here, in that they've acquired for one or more purposes that include the purpose of disposing of, CB6. So what you do then is then go down to this list down here and say, okay, CB6, is there a CB6 anywhere? No, it's not, so there's no exemptions for that, except you could probably refer to the Brightline Test, which we'll go through in a minute. But other than that, there's no other exclusions. Let's do another example. Maybe this one over here. So part of an undertaking or scheme commenced less than 10 years of the land being acquired and involves development of the work that is not minor. So basically, you are a developer, you've bought land, and within 10 years, you do some development work. Maybe you're building the foundations, maybe you're building the whole apartment, maybe you're building a house on it for the purpose of sailing. Like you're an undertaking or scheme, right? So it's for the purpose of disposal, right? So it's CB12. So we then look down here and say, okay, what are the exclusions for that? So CB12 is here. So if the business premises exclusion applies, and we'll talk through what that means in a moment. What else? Which one? CB12. CB12. So we've also got farmland exclusion. So if the land is used for farming purposes, CB12, that would be excluded. Number 12. So you can build like a house on a farm, and it's not going to be assessable. CB12 is assessment land exclusion, and CB23. And also residential land exclusion, if the land is residential. However, for the residential exclusion, the land and house must be less than 4,500 meters squared, and it needs to be required for reasonable occupation and enjoyment needs. So you can't just go and build out, 30 blocks of land and build a village of new houses and sell off those, because the package must be less than this. And it also can't be a mega mansion either, right? If it's a mega mansion that's beyond reasonable occupation and enjoyment needs and greater than 4,500, then you wouldn't get the residential land exclusion. So anyway, that's basically how you look at a situation or a case study where they've disposed of land and you need to figure out if it's accessible or not. You look at the situations where it is accessible, then you look at the exclusions, and also just check Brightline Test as well. So let's go through the Brightline Test now. So this is applicable to residential land, if you've got like a development of residential land or whatever it is. So what this is it's a test that applies to disposal of residential land if the taxpayer first acquired an estate or interest in the land after 29th of March 2018. So in this exam question, you've got an individual taxpayer or company, whatever it is. They've bought land and they bought it in April 2018. They've then disposed of this in 2020 and they want to know if this is assessable income. So what we would do is we would look at this test, and the gains also need to be made up within 5 years of acquisition, so 2020 would be fine, disposal. But if it was in 2030, we probably couldn't use the Brightline Test because it's too long of a period. So the 5-year period for the Brightline Test we usually commence at the time of the title of the property transfers, and at the end of the agreement is entered into to sell the property, which is referred as the Brightline date. So there's a main home exemption, which provides that the Brightline Test does not apply if the land has a dwelling on it that has been used predominantly as a person's main home for most of the Brightline period. So you're obviously not going to pay tax if it's your own personal home, but what if it's what if it's a rental property? What if you own 6 properties and you've disposed of it? Then you would probably apply this Brightline Test. So a similar exemption is available where trustees own the land and the beneficiary's main home is on the land. It's basically when the main residence is in the trust, held by a trust rather than the individual. But you only get one main residence, so it's basically the same point, just different entity. Okay, so next is, however, if a person habitually sells their main home, this exclusion cannot be used. So basically, if you regularly sell your main home, maybe like every year or something, go and buy another one, because in that case you're probably flipping it, selling it, making a profit, buying another one, flipping it, selling it, right? You'd be a habitual seller if there is a regular pattern of acquiring and disposing of residential land, so you can't use the Brightline test if that's the case, especially never mind. In addition, a person who cannot rely on the main home exclusion if they've already relied on this twice in the 2 years prior to the Brightline test. So basically, you can't do the main home exclusion every single year. So if you want to sell your property and get exempt from it, you need to hold it for a longer period of time, and it needs to be your main residence, basically. And also, land that's inherited and subsequently sold would not be subject to the Brightline test. So down below, we've got a couple of examples from the CSG, just to kind of outline in a little bit more detail some, real life applications of some of these tests above, because it can be a little bit confusing. So a couple of different scenarios and what's the tax implication. We've also just got a visual summary of the list that we went through above, these land sections up here. Where are they? Over here. So the different scenario and the relevant section, and also what the exemptions are over here. So if you prefer to look at it that way, that's fine. Otherwise, this approach over here is equally fine, where you just look at the relevant issue. Whoops. And then just look at the relevant act and see if there's an exclusion relating to that. Or you can just go through this way and say this is the relevant section, and then these are the exemptions over here. So just to clarify and re-go through it again, normally residential land is not taxed, right? You either get a main residence exemption, or it's not falling under the definition of personal property because land is explicitly excluded. The only case that land is really accessible is if it occurs in one of these situations, which are quite specific and generally to do with some sort of business involving developing the land, which usually captures property developers, right? But in any other situation, generally land would not be accessible, whether that's a residential property, whether that's a main residence, or whether that's just I guess those are the two main situations. So just to recap what the purpose of the Brightline test is it tries to capture some more of those people into the tax net, right? So if you're selling your residential property, in some situations, the Brightline test will apply and you actually have to pay tax. And that's basically, if you satisfy any of these conditions, is that you, it's not your main residence, otherwise the main residence applies, but basically you've sold your house within 5 years of acquisition, and yeah, that's pretty much it. And you've acquired it after 29th of March 2018. If you bought it before then, and it's a residential land and you're selling it, then you're not going to have any tax payable. So let's go through this example from the CSG. So in November 2017, Jasper entered into a conditional agreement to purchase a rental property. The conditions were satisfied and settlement occurred on 20th of December 2017. The appropriate transfer instruments were registered under the Act and title was transferred on 21 December 2017. The property was rented out from 1 January 18 to 30 September 2018. On 20 October, Jasper entered into unconditional agreement to sell the property. Settlement of the sale occurred on 30th November 2018, and title was transferred the following day. So he acquired the land in 2017. Therefore, the 2-year Brightline rule applies, i.e. interest in land first acquired after 1st of October 2015, before 29th of March 2018. So the purpose of starting the 2-year Brightline period, the rental property was acquired on 21 December 2017. The Brightline date for the disposal of the rental property was 20th of October 2018. As the Brightline date for the disposal of the property was in 2 years of its acquisition, any gain on the sale will be taxable income to Jasper in the 2019 income year. The main home exemption does not apply here as the property was rented out for most of the Brightline period. So because he was captured under the Brightline test, even though it was a residential property, not his main residence though, even though it's land, he still has to pay tax on it because he got caught under this provision here. There's a few other examples that we could potentially go through. Land sold used for residential purposes. So this is just going to go through some of the exemptions that you can rely on for land purposes, including residential land exclusion, where the land is more or less than the 4,500. But I won't go through that in detail. And then also land sold used for business purposes, which just discusses where there's dual intention, both of it to dispose of it in future, but also to use it for premises. So how do you treat it in that situation? So you can go through those examples in your own time if you want, but otherwise it's just following the facts of the case and applying it against one of these situations: disposal of land, or if it's residential, potentially looking at the Brightline Test. Okay, so moving on. So acquisition date of land for all provisions excluding the Brightline Test, which has specific dates in terms of the contract and when the time the title of the property transfers to the taxpayer, and the end of the time an agreement is entered into to sell the property. But for any other provision, the acquisition date of land, the criteria used for determining whether the proceeds of land are taxable include reference to the point in time, so it's important to know what the date of that is. So Section CB15 was introduced to clarify the date that the land was disposed of, and it's defined as the date that begins in a period in which the person has an estate or interest in the land, and this will generally be the date that a binding agreement is entered to, even if the agreement is conditional. So the conditions that require director's approval or due diligence are examples of conditions that may mean a binding contract does not yet exist. And the acquisition date for the Brightline Test differs from the acquisition date under the other land tax provisions. It is defined in Section CB6A and is generally the date on which land transfer is registered and the person gets legal title. So here's an example down here of figuring out what the exact date of the acquisition of land is when you've got a bunch of different dates in terms of mortgage approval, finance, agreement, and things like that. Exchange of money. So how do you know which one is the actual acquisition date? Well, we want to look for this date here. It's generally going to be the date that a binding agreement is entered into. So if we look at this example, we want to look for the date that a binding agreement is entered into. So if you look through it, it entered into agreement to purchase some land on 15th of July. So that's going to be the date, even if it's conditional. So it doesn't matter that it's conditional. This is going to be the settlement date here, 15th of July. So it doesn't matter if her mortgage approval came through later or actual settlement, like exchange of funds, comes through later. It's when you enter a binding agreement is the settlement, not the date of transfer of money. Now, deductions, I touched on this a little bit earlier in terms of, remember from the earlier chapter where we went through deductions, it's super important that there needs to be a nexus to assessable income. And if the land isn't on revenue account, then how is there a nexus to assessable income? So that's the general basis, is trying to match assessable income, or have that nexus to assessable income to allow a deduction here. So where a land tax provision applies, as we discussed above, so normally land is not assessable, so therefore you normally wouldn't get a deduction. But if any of these applies, it means the land is actually, or a Brightline as well. If any of those applies, then it's assessable income, the disposal. And in those situations, that'll become assessable income. And therefore, to ensure the person only pays tax on the profit they derived in relation to the disposal, not the revenue, a deduction is generally allowed for the cost of the property disposed of in accordance with DB 23. Same principle we talked about before, is there needs to be a nexus of the deduction to assessable income. If the assessable income's not there, you don't get the deduction. Now, if you've got a scheme involving significant expenditure under CB 13, the deduction rules operate slightly different, allowing a deduction for the market value of the land at the date that the undertaking or scheme commences. Now remember, CB 13 per above is this one here. Part of an undertaking or scheme that is not taxable under another provision, including development of division work that involves significant expenditure being incurred on certain types of activities. So it's a large amount of money being spent on certain activities. So you can actually get a deduction for the market value of the land at the date that the undertaking or scheme commences. So it's kind of like trading stock, right? How, if you're going to sell your trading stock for, even if you haven't sold it, you're going to get a deduction, and you calculate based on the opening and closing balance of the value of the stock. Similar with this. So in addition, the special deduction rules apply to land disposals that are taxable under CB 14, which, if you remember, or you can check the list above, is the basis that the disposal of land has occurred within 10 years of acquisition, and at least 20% of the profit has arisen due to certain factors, e.g. the granting of a resource consent. So that wasn't one of the last ones on the list above. So the person will be entitled to a deduction for both the cost of the property and the greater of $1,000 or $10,000, 10% over the excess over cost multiplied by the complete number of years the person held the land. So if you do come across CB14 above, the next step is to check in the question, are they entitled to any deductions and any specific deductions? So generally, the first test is it assessable income, therefore I'd be entitled to deductions. And then you go through and actually check the relevant section of the Act and see if there's any specific deductions and calculate it on that basis. So for example, CB14, you'd check this one and say they'd also be entitled to $1,000. They'd only be entitled to $1,000 or 10% of the excess over cost multiplied by the complete number of years the person held the land. And finally, there's also special deduction rules when the taxpayer derives income solely under CB6A, which is the Brightline Test. So if your property was normally not assessable but it's been picked up under the Brightline Test, there's special rules that you need to consider for deduction. So while the cost of the property will generally be deductible under DB23 as revenue account property, so you sell it for $2 million, you bought it for $1 million, you get a deduction, you only pay the difference, right? So it's basically $1 million profit, right? But EL20, which is another section, limits the amount of deduction to the total income derived from the land transactions under CB6A, CB14. So those deductions denied are able to be carried forward and able to be available to offset against income derived under CB6A and CB14 in the following year. So this has the effect of ring fencing any losses resulting from property transactions under CB6A. Alright, moving forward. Associated persons rule. So why do we need to know about associated persons in property transactions? So there's a couple of reasons. So the first one is the effect of the associated persons rule on land tax provisions is the person who sells land is not subject to one of the land tax provisions based on their own circumstances, may be taxed if they're associated with a person who is subject to them, such as a builder or developer. So for example, if my company, who I'm the sole shareholder, sells property to myself, I could be pulled into these provisions and also assessed on this basis as well. And while the associated persons rules are relevant to the application of land tax provisions, they're not relevant in relation to the tax provisions applicable to the disposal of personal property. So it's not relevant to personal property, but it could be for residential property, could be for investment property, or if you're a business and developing property, it could fall under this one as well. So just keep that in mind that generally the property rules need to be at arm's length, and they don't need to be with unrelated persons, but if you are a related person, the chance of it being a non-arm's length transaction is greatly increased, and therefore the related person is pulled into the transaction. So there's a couple of tests to determine whether or not you're an associated person. So if there's two companies, if a single person or group of persons own at least 50% of the voting interest in both companies, they're deemed to be associated persons. Or if there's control between the two companies by the same person or group, it's an associated person. Next is a company and a person other than a company. So this is where there's a company and a person who are associated, where the person has a voting interest of 25% or more in the company. So basically you're a key shareholder in the company. You're deemed to be an associated person of that company. Two relatives. So if there's two individuals other than companies that are either spouses, partners, de facto partners, or one person is an infant child of the other, they are relatives and therefore associated persons. Next is trustee and trustee. It's basically when there is a trust and then the trustee of one trust and another trust are basically associated persons. And we'll talk about trust a little bit later on if you're not sure what that is. But it's a three-party relationship in a trust. One of those parties is a trustee. And if that trustee, similar to a shareholder, if they're connected to two companies, then those two trusts are deemed, and trustees are deemed to be associated persons. Then you've got person and trustee, which is a person is associated with a trustee of a trust, where the person is either the settlor of the trust or a person with the power to appoint or remove the trustees. So a settlor is another concept within trust, which we'll talk about later on. So don't worry too much if that doesn't make sense to you. Partnership, so similar if the entity is not a trust but a partnership. If there are two partners within the partnerships, then they're deemed to be associated. Look through companies is basically when you've got multi-layers of companies, but at the end of the day, if you look through all of the different layers and said that person still controls the other company, they would be deemed to be an associated person. And then finally, the tripartite association test. which is basically if person A is associated with person B and person B is associated with person C, then person A are also associates. So you've got the triangle. If this person is associates with this one and this one's associates with this one, therefore these two are also associates. Okay, so the last point on this chapter before we wrap up is around relationship property. So a settlement of a relationship property is defined in section FB1B to mean a transaction between parties to a relationship agreement that creates a disposal and acquisition of property under subpart FB. So this occurs usually when spouses divorce. So if you've got parents, they get divorced and they own the house together. And if one of them has to dispose of the property because of the court saying, look, you need to pay your divorced spouse half your money, obviously that money is going to come from selling the property. So where that happens, it's deemed to be not to incur an income tax liability, where they transfer the land pursuant to a relationship agreement. The relationship agreement is something that the courts, put in place. They're saying that you have to dispose of this property to pay this bill, basically. So it's just to make sure that if you're getting divorced and you're already out of pocket from that, you don't get hit again with the tax bill from the disposal of land. So the land is deemed to be transferred from the transferor to the transferee at the original cost of the land to the transferor. This ensures that no tax will need to be paid. So it's basically saying that what you're selling it for, even if you're selling it for $10 million and you paid $1 million, it's going to say we're going to deem that you are selling this at $1 million and therefore there's no gain because there's no differential between your revenue and your cost. And the transferee is treated as having acquired the land on the date it was acquired by the transferor. Therefore, if the transferor acquired the land 5 years before the relationship was entered into, the transferee will be treated as having acquired the land at that time. So the disposal is deemed to occur at the market value of the land at the time the undertaking or scheme commenced plus the expenditure incurred. So basically you're just transferring the acquisition history of the asset to the other person or to whoever it's being transferred to. So you're saying if we bought this asset for $1 million 10 years ago, let's say 5 years ago, and it's worth $10 million now, instead of being sold for $10 million at today's date, it's basically going to say you're going to pretend that you bought this at $1 million 5 years ago, and therefore when you then sell the property later on, when you would have otherwise, you'd then pay that differential between $1 million and whatever you sold it for rather than the market value at the time. I.e., there's designed to be no gain or loss at the time of that transaction, but it's basically just saying if you ever did sell it, you'd be in the same position if this relationship or this divorce never occurred. Okay, so that's the end of the chapter. Let's just do a very quick recap of what we went through. Basically, because there's no capital gains tax in New Zealand, there's a strong incentive for people to put things on capital account in New Zealand because they won't pay tax on it. So generally, property is on capital account, so therefore, you wouldn't pay tax on it in New Zealand, but there are certain provisions that kind of pull property, or land, I should say, into the revenue account. So not land, property, so that would be like buildings and things like that, right? But there are also relevant sections talking about land specifically. So the first thing to consider is personal property. If you're running a business or if you have profit-making intention, then it's deemed to be on revenue account. You've got to pay tax on it, okay? But there's also issues about land as well in certain situations where land is also pulled out of that definition, out of capital account, and pulled into the income tax payable pool, right, where you're assessed on it. So it's all of these different scenarios that we went through. Primarily it's around development of land. That's the common theme, but there's a whole bunch of different scenarios which we read through and you should probably read through in your own time. Or if you get the exam question, you just come back to this section and see which one of these applies. But you also have to look at exclusions and also residential land. There's also the Brightline Test. So if you're selling a residential property and you've acquired it after this date, you could still have to pay tax on it because of the Brightline Test. We also talked about the date that land was acquired. It's basically when you enter the contract into it, not when you pay tax on it. And because the dates are very important in tax, because A, it might not be in the same income tax year, but also a lot of provisions, it's within a certain time period, i.e. you must have bought it after a certain date or held within a certain period of time for the provision to be enacted in your particular situation. And of course we talked about deductions as well. So obviously the general principle that we discussed earlier on is that for a deduction to to be allowed, there needs to be a nexus to assessable income, and obviously that gets a little bit tricky with land and buildings because we don't know if that's going to be taxed or not. So you need to consider first, is it taxable based on if it's personal property, what the intentions are, and if it's land, if any of these scenarios or exclusions or Brightline Test applies. But if it is assessable, you can get the deduction unless it's been brought into account by one of these specific provisions like CB14, CB6A, then you need to consider the specific rules around deductions for those, which are those two there. And that's pretty much it. So hopefully you found that useful, and I'll see you in the next video.